Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host. So today I'm joined with Jose Mayora. How you doing today, Jose?
Doing very well, thanks, Kirk. Thanks for having me.
Yeah, glad to have you on. So Jose, maybe you can tell listeners a little about your background if they're not familiar with you.
Sure, absolutely. I currently am the senior portfolio manager and co-founder of a public equities hedge fund called DeVita Valley Growth Fund. We pretty much do a value investing approach for investment decisions. I've been in finance and economics pretty much all my life since back in college. Then I did investment banking for a while, got the CFA, did my master's in economics and all of that. But I was always very passionate about value investing and kind of the investment merits the approach and the strategy has. And so eventually I was able to get myself to achieve my dream of funding a fund using that approach. And that's basically the summary of it.
Okay, cool. So you're more or less a value investor. Um, we've been in a market which has not rewarded value investors for quite some time. How do you invest in markets like this where your approach is not necessarily the top approach compared to like what other people are doing?
No, absolutely. Well, I think part of it is really understanding that there are various kind of different approaches to value investing. I mean, we all kind of believe in the same fundamental thing, but then when it comes to the nuance, there can be different approaches. So it is true that from a kind of conventional way of understanding value investing, it hasn't been necessarily the best approach in the past 10 to 15 years. But that's because most people associate value investing with trying to find companies that are in a more mature stage that have low price to earnings ratios or any financial metric or ratio that is relatively low. And if you, in fact, have kind of made that your entire focus of your investment thesis, you probably didn't do as well as having been invested in the Magnificent Seven that maybe didn't fit those traditional price to earnings ratio hurdles, right? And so you stayed away from those type of investments. But due to the growth and the reinvestment opportunities that they've had, the returns from the stock price perspective have been really large. So if you think of value investing and your approach is more of a kind of like the conventional way of understanding it, then definitely it's a challenge. In our case, however, we don't view value as only playing in kind of that mature space. We view value as trying to find a business that is worth X and us paying significantly less than X. And you can find those type of opportunities in the kind of more growth arena or companies that are more in an earlier stage of their life, less mature and that have growth opportunities ahead. And so if you view value as that, and you're not necessarily shying away from a business that might be 30 price to earnings ratio just because of that kind of traditional value investing mindset, then you wouldn't have been impacted as negatively. So that's one of the reasons, in fact, I kind of wanted to write the book I just launched, Wall Street's Blind Spots, is to kind of emphasize the fact that value is not about just finding low price to earnings ratios, right? It's about finding those opportunities where you can get at a discount. And I do believe that there were in the past 5 to 10 years, and that there are now opportunities that are discounted or that are undervalued within the growth phase. They're harder to find in this euphoric type of market, or at least quasi euphoric, but you can find them.
Yeah, so let's talk a little bit about how you do find them because I know, if you look at like the last 15 years, basically it's Mag 7 or bust, and most of the returns in the markets have come from them. Um, there are great companies out there, but they're just not performing for one reason or another. So how do you determine, because then, for example, there's things like last year, which I haven't heard a single person talk about. Like Walmart was up at like 100% last year. Like
Incredible.
what world does that happen? But it did, and no one's even talking. I don't think people noticed. So I know there's obviously opportunities out there in the value space, but how do you identify the good ones from the bad ones? Because ultimately, a value stock could stay value for a long period of time.
Nah, absolutely, absolutely. Well, uh, our approach and the approach I would generally advise is to first kind of look at the places where not a lot of people are looking and where there's not a lot of excitement in general. And that goes both industry wise and geography wise. So, right now, I would argue that while the US might not be as crazily valued as maybe it was in the dot-com era, although that's questionable, it's still, kind of pretty expensive. So, in general, if you're thinking to look at undervalued opportunities, you might think, okay, let me look at other geographies, at least in most cases. And maybe once in a while dip your toes in the US to see if there's something interesting there. But I would say look at different geographies all the time as well. And then the same thing goes for kind of like industry sectors. If you go and look at kind of like the sectors that are very popular at the moment, and you think about anything that's indirectly or directly related to artificial intelligence, well, it's going to be difficult to find something that's undervalued given the hype that's around those industries, right? So part of it is first knowing where it's likely that you're going to find undervalued opportunities and go there and don't waste time in other places. But then the second thing is I try to source my ideas in a very impartial way. So I do like the old kind of Warren Buffett traditional approach, going A to Z. So I may grab an index in a geography that I think may be generally undervalued, or at least on a relative basis, or an index for an industry, or an index in some capacity. Or maybe I just say, okay, I'm going to look at the last 5 years of IPOs and look at that list of what all those companies can be. And I go literally one by one. And the first thing I look at is the cash flow statement. And I see, okay, what has been their cash flow producing capacity? And most importantly, what have they done with that cash, and have they been compounding with any reinvestments or not? And I assess that just very briefly or very rapidly with the current valuation. And if it seems like just at a high level it's undervalued, then I say, okay, that's a candidate for me to go do qualitative research. But this process can take maybe 300, 400, or 500 companies literally going one by one before you actually find one that seems attractive. Because in general, if markets are not undervalued as a whole, like during a recession, the undervalued opportunities are a diamond in the rough. So you have to be patient and do the work. But I do also want to emphasize what I said before. I try to be impartial because if you go out there and look for opportunities through like sell side analyst recommendations, or what other analysts are saying, or a headline that you saw, it kind of already imposes some pre-opinion about the stock yourself, and you're subject to confirmation bias oftentimes. And so I try to keep it impartial, look where I think there can be hitting opportunities just based on the general environment in that regard, and that's kind of how I go about it.
Okay. Yeah, I mean, I've definitely noticed there are a number of opportunities more now than I think there were like a few years ago. I mean, if you look at the whole restaurant sector right now, it's just getting, in the consumer product sector, it's just getting creamed, which is good. I think we need that once in a while. Um, but it does make me wonder with sky high valuations across the board, with PEs through the roof. Um, do you look at things relative or do you look at things in historical terms? Because I think we've seen a inflation of a lot of numbers across the board. So how do you look at that way? Are you looking relative to what's going on, or are you looking like in absolute terms?
I would say I anchor on an independent basis, like on what you're calling historical terms, like whether it makes sense regardless of what other opportunities are out there in terms of probability of getting a decent return. But then I do add a component of relative, but not to see whether my opinion of valuation is justified or not. I think can lead to a lot of mistakes. But more to see whether there's a better alternative. So, if, like, say I find a great company that has a 15 times price to earnings ratio, and I think that independently that's justified because of its growth prospects, its reinvestment prospects, or whatever it is. Well, that's great. But if I then find another one that's 10 times price to earnings ratio with similar risk reward characteristics, well, I'm obviously going to go with the 10 times price to earnings ratio, right? So I do take the relative perspective, but only to kind of like the downside, not to the upside. Like I'll never say like, oh, the price to earnings ratio in the S&P 500 right now is around 30 times. So if I buy something at 22 that's comparable in terms of risk reward to S&P 500, I'm going to go into it. And I don't like that because of kind of what you're implying is like, well, who's to say that the 30 price to earnings ratio of the S&P 500 is justified, right? If you anchor yourself to what other people are paying, that's where you can lead to make big mistakes.
Yeah, and it's hard because if I go back and look, a lot of the things I look at for valuations, you can go back to like the 70s, right, and look at how horrendous that was. But there were some great valuations back then. Like if you had been patient enough, you found some great deals, which in many ways lined Warren Buffett's legacy because that's when he started to buy is, at those prices when it was crazy. But you can't find those now or not rationally. So I would think in some ways the real question is, are we in a different paradigm? And I don't mean this time is different. I mean, are we in a
Mhm,
different
mhm.
paradigm where the liquidity in the system has gotten so much that you can't rationally see valuations like we did in the 70s because there's just too much money floating around and it just won't happen. I mean, I wonder, like, what are your thoughts on that?
Yeah, well, I definitely think it's very, very difficult in this type of environment to find those kind of undervalued opportunities. Like if you go to like the 70s where you mentioned, or talking 2009, 2010, even 2011, obviously post-dot-com burst like 2003 or things like that. Like it's not that hard to find undervalued opportunities or decent opportunities. So I would agree that right now it's very, very difficult. But that doesn't mean that there aren't different corners of opportunities. They're just harder to find, harder to look. And at times, you might have to be willing to take a little bit of more uncertainty or risk. And that's where kind of maybe position sizing comes in. And instead of putting maybe 5% on it, you put 2% or whatever it is. So it makes it generally more difficult. But I would argue that there are some pockets where things can get pretty interesting. And the benefit of being a value investor is that you're okay having concentrated positions. So if you're trying to find undervalued opportunities and have a 50 company portfolio, you're never going to be able to achieve it. I mean, it's impossible, in my opinion, to find 50 undervalued opportunities here that are within your circle of competence, that have a good risk reward, low probability of downside, blah, blah, blah. But if you're okay with some concentration and you're thinking about having maybe 10 to 15 positions, like in our fund, we only have 16 positions right now, then you can find those kind of pockets of opportunity because you're being very selective. And just to give a more maybe practical example, like if you go to China, there's a lot of, it's starting to change a little bit now, but there's a lot of negative narrative around China, geopolitics, internal politics, and just because of the prices of assets there haven't gone that well in the recent past. There's a lot of FOMO and psychology involved, etc. So in China, I do believe that there are some very good, high quality companies that trade at very reasonable, and in fact, in some case, I would say gift type valuations. But because of that general psychological environment, people are willing to kind of forego those opportunities. So that's one example. Again, there's different sectors that we might be able to talk about, but that's only possible in the context of being willing to be concentrated. If you're not being willing to be concentrated, I mean, you're toast. There's no chance you're going to find undervalued opportunities.
Yeah, that makes sense. So here's a question I wonder. So I think about things in, we're talking about like crashes and, back in the 70s, there weren't crashes. There were just declines, right? Now everything's a crash. It doesn't decline. It's not like Japan. It's not like, the early 2000s. It's just everything's just a crash. So let's say tomorrow we have a crash and the market's down 50%. How do you, and assuming you're not fully invested,
Mhm.
how do you look at that as an opportunity? Like, what do you do at that moment to make the most of that opportunity?
Absolutely. And I actually would love for that to happen. Obviously, I feel bad for people's 401ks and the stress it causes. So it's not like scenario that I'd want in general for people. But from my perspective, selfishly, I'd love for that to happen, right? Because it'll become much easier to find the undervalued opportunities we're talking about. And I think if there's a crash of 50%, that's probably a mix of psychology and declining fundamentals, at least temporarily. And what happens typically in crashes is that you have declining fundamentals, less profitability, lower margins, et cetera, et cetera. And that's why, as a whole, the market can go down. But the market is not very discriminatory in the short term. So if most companies are doing poorly, or half the companies are doing poorly and have risks, the market will, in the short term, punish most, if not all, or most of the market, right? And you can benefit because some of those companies that are have experiencing a decline, that decline is not justified, even if you think about the short-term fundamentals. And so you try to find again the diamonds in the rough in that scenario, but finding the diamonds in the rough in that context, because the market's not discriminatory, is going to be much easier because there will always be, a couple of companies that are doing really well despite that decline. And like an easy example to think about is in 2009, I believe, Alphabet or Google at that time, its stock price, I think, had declined, I don't know, it was 40 or 50% from its peak in 2007 or whatever. And in 2009, at some point, can't remember the exact date, but at some point it was trading at a price to earnings ratio of 20 times. And at that time, the growth rate of Google was, like, again, I can't remember the exact amount, but it was way north of 20% in terms of both revenues and also cash flows. In fact, cash flows were growing even faster because margin were expanding. So if you're an investor, then you're saying, okay, Google's a super high quality company, assuming you believe that, at a 20 times price to earnings ratio, this is an absolute gem, right? And that's the type of opportunities that you get when the entire market crashes, just because, again, it's not discriminatory. It wasn't justified for Google to go fall as much as maybe it was for an auto company, for example. But the market didn't care. And that's when you kind of turn around and say, okay, here's where I'm taking a concentrated position because the risk reward is just too good to be true.
Yeah, that makes sense. How do you I've noticed with crashes, what tends to happen is in a crash, the crap does the worst. Like just the garbage stocks do the worst. But when we rebound from it, they do the best. So I've struggled with this because I look at it the same way you do. Like, hey, it's a crash. Let's go run around with the net and pick up all the good deals, right? But at the same time, like if you want to make the most money coming out of a crash, it's you buy the junk, the lowest quality stuff, and that tends to do the best because it's gotten beaten up the most. So, how do you square that too? Because ultimately, even if you look at like if you look at the tech bubble bursting, the Nasdaq was down like 80%. But companies like Microsoft, I think, took till like 2014, where they had like really good metrics at that time because they still had Ballmer at the hub and he was lighting cash on fire every year. I think a buddy of mine told me that he discounted the stock by Ballmer destroying 1.5 billion in cash every year. Like that's how he discounted it. I was like, all right, that sounds about right. Nordell has done a great job, but prior to that, it was actually really cheap. You could have I forget the metric. A buddy of mine told me that you could basically take it private. You could go borrow money at it because the rates were cheap, and you could buy all the shares. Like you couldn't do it because it was too big, but
In theory, because it was
in
so
theory,
punished, the market cap, that the debt would have been enough from a cushion perspective to its assets or whatever it
yeah,
was, that the bank would have felt comfortable.
it was crazy cheap. But it took. I mean, 2003 was the bottom of the tech bubble bursting, and 2014 is when Microsoft, like arguably one of the best run companies out there, it took that long, 11 years
Mhm.
to
No.
really start to take off again. So how do you square that? And the market took off, like a rocket after that, but some of the value stocks just kind of stayed in the doldrums. So how do you deal with that?
No, absolutely. I'd say on the kind of the comment that the stocks that get beaten down the most tend to be the stocks that recover the most. I'd say definitely that's generally true. Uh, the problem I have with that though, and this is personal, not like I have something against somebody doing this because it is an opportunity to make outsized returns. The problem is that it's very difficult to kind of know where even generally the bottom for those types of stocks are. So you might have whatever construction business and it falls 70% and you're saying, okay, this is super cheap. But nothing stops it from going down 90%, which at that point would actually be a 50% decline, even from the price you paid for it, which was already at a 7% decline. And as a value investor and a patient investor, you shouldn't necessarily worry about that if you're confident of the underlying economics. But it does present more of a challenge. One, from a psychological standpoint, I mean, it is uh, harder when it's not a super high quality company to have the conviction it takes to be willing to kind of like live through another 50% decline on average on your stocks just because that's where your focus is, or at least part of it. But then the other thing is uh, those stocks that are more maybe cyclical, if you want to call them, and that get beaten down the most, uh, they do have a risk of not coming out, or a higher risk of not coming out well on the other end. On average, they're probably going to come out relatively well, but not necessarily, right? And so that's one thing I personally don't like to play too much in that realm, even though what you're saying I think is true. But then the other thing is I think when you study history, and I do, and I know you study history a lot, I think we might forget that crashes, uh, although rare, can take a long time to recover. Like we think 2008 financial crisis, it wasn't that long. I mean, a couple of years you were there. Dot-com crash, uh, prices of stocks took a little bit of time, but the economy didn't take that much to recover from a recession standpoint. And if you look at the crisis in the past 50 or 60 or 70 years, it's generally true that in within 2 or 3 years the economy kind of was back up and running. But that's not necessarily true. We had the Great Depression where you had 9 years or 8 years or whatever it is of enduring economic malaise. And if that happens, and you're stuck with more kind of mediocre type companies in terms of quality, in the hopes that they're gonna their price is gonna go much higher because they got more beaten down. I mean, it's a risk. Personally, I'm not willing to live because again, psychologically, it's very difficult to endure in that context.
No, I like I like your opinion. I agree. It's hard to square both sides because on one side you look in history and you say, well, here's what happened. But I also remember living through those times, and it was like 2008 in March was squirrely.
No.
You didn't know if your cash was safe, even when the Fed stepped in and hit their money printing bazooka and everything started to go up. You didn't know if your cash was safe. There were years before I would. I don't know how long it was, but it definitely took years before I felt comfortable.
Mhm.
And it was interesting times for sure. And we were not majorly exposed, but we were worried about our cash. Like, I mean, look at Silicon Valley Bank, right? Look at
No.
the whole banking sector was on edge for years after that. So I agree. It's just I think it's hard to play both sides, right? Because you're watching everybody else make money, stupid money, right? As I call it. You know, you're
Yeah.
you're like you're betting on you're going on a roulette and you're just betting on the green number to come up and you're like that's not smart. But everyone's doing it and they're winning. And you're like, well, it's still not smart, but they're winning. Like, what should I do? And you're like, well, here I am, hitting singles and they're all hitting home runs every single time at bat and I'm playing small, but it's the right way to
Yeah.
do it, but at the same time, it doesn't
Yeah.
feel right.
No, I hear you because the psychological aspect goes both ways, right? It's hard in the fear side, but it's also hard it can also be hard on the FOMO side.
Yeah.
And 100%. And that's why at the end of the day, every investor has to kind of have a very strong philosophy of why they prefer to be where they prefer to be and act the way they want to act. Because when you know it or believe it at your core, that's when you can maintain the discipline, right? If you just kind of uh, have a soft opinion on what's the best strategy going forward for you and your financial objectives, etc., then it's really easy to kind of fall into the fear of FOMO in the moment, right? And you also have to be very kind of true to knowing yourself and knowing whether you actually have the emotional intelligence to be playing the strategy that you want to do, right? Because sometimes people lie to themselves and they say, "Yeah, I'm gonna buy when things are low," but they don't necessarily have the patience. They don't necessarily have the time commitment to maintain the research that'll maintain that emotional intelligence and things of that nature. So I agree with you that the psychological aspect goes both ways, and it's difficult in either side.
Yeah, and I think the challenging part is um, doing it in the moment, right? Like we could sit here and speculate, because you look at COVID, right? The whole economy was shut down, like the whole world economy was shut down, and yet the stock market ended up like double digits for the year. Like not only did it rebound, it rebounded rather quickly.
Mhm. Yeah.
And I'm sitting there scratching my head and be like, what is going on? Like the global economy still wasn't working properly. People were still locked in their homes for most of the year, even though, you know, it was better, but it wasn't better. And yet we were up double digits for the year. It didn't make any sense. And I think this is the part that I struggle with because I'm a value investor at heart. Like I think about the world that way. I want to find a good value, I want to find a good stock and sit on it. But I'm managing money for other people, and you don't get rewarded for being right if you're late. Right?
Yeah.
If you bought Microsoft when it was cheap and it sits there for 10 years getting cheaper, you're not rewarded for that. You're actually yelled at for that. And um, and then if you don't do it, you get yelled at for not doing it. So it's I think part of the challenge as an investor and people are running their own money, it's so much easier because you only have yourself to adhere to. But when you have other people, there's so many other emotions to it. I mean, I had clients call me and like, why are you not buying Apple like in the middle of COVID? I'm like, because I don't want to own Apple. Like there's like thousands of stocks out there. Why does Apple need to be the one? Like
Uh,
then you see
yeah.
Amazon where everybody's shutting their homes, ordering on Amazon, and yet Amazon was flat throughout that whole period. Like it, none of this stuff makes sense at some level, but um, I think the challenge is you need to get rewarded for good behavior. And I feel like value investors haven't been rewarded. I mean, it's okay to underperform the index because
Mhm.
that may not be your metric. But, if you're not getting rewarded at all for good behavior and you're getting highly rewarded for chasing seven stocks that are highly overvalued, um, how do you balance that with investors? Because at some
Mhm.
point, investors get tired of you being correct, but not the timing correct. I'm not saying this is you. I'm saying every
No,
value.
yeah, in general, no, no, no. But I agree with you, and it's one of the biggest challenges when managing other people's money is to try to find that balance of what's actually the best decision by itself, and what's the best decision for the context of your investors, right? And just to give you an example, and I'm sure you'll appreciate this, at a personal level, I think the right number of stocks to have in a portfolio if you're doing value investing well and I'd say this if you're doing it well, I emphasize it because I don't want people to think that that's what I advise for most people. But if you're doing it well, in my opinion, the best number of stocks to have in your personal portfolio is maybe 5 to 7. That's a concentration that I think is the best. That being said, when you're managing somebody else's money or a group of people's money, the 5 to 7 may not be the best thing because of what you're saying, right? Because maybe the 5 to 7 gives you more volatility than they're willing to live with, and then they're constantly yelling at you, and that kind of can destruct your emotional intelligence, for example, and then it leads you to bad decisions. Or maybe, as you said, it requires a ton more patience because maybe three of your positions are the Microsoft examples you laid out. And so maybe the other three are helping you kind of do okay, but the flatness of the other three, or two or four, or whatever they are, is keeping you from underperforming for quite a while. And investors might not understand that and appreciate that. And so there is definitely a balance to achieve. And that's why, for example, instead of having 5 to 7 stocks in the funds portfolio, we have more like 14 to 16. That would be kind of like the average to try to balance that out. Definitely has to be taken into account when it comes to third people's money. And then the other thing is one thing that we're very proud of at the fund is that in contrast to many different hedge funds, we have a policy that we have a kind of one-on-one relationship with all of our investors. And obviously, that's why we can't be a huge fund in terms of the number of investors. And that's because we want to convey and educate the investor, not just in the initial pitch, but also through time, in that kind of more individual capacity, so that they kind of understand. And we're very transparent of what the trade-off is of going with our strategy versus going for an index strategy. And so it's not perfect because people at the end of the day kind of only absorb part of what you tell them for various reasons, much of which is psychological. But it does help because when you're in those pockets of kind of difficulty where you're either underperforming or you're not doing well or you're asking them to have patience, it's not the first time they're hearing about it. It's you told them in advance, like, look, I might need to ask you for your patience at some point, or look, this might fall 10 or 20% in area at some point, even though the S&P might be 10% up. I see that transparency in general helps, but it's still a challenge. I mean, it's a very difficult challenge.
Yeah. One thing I wanted to ask is, Warren Buffett is seen as the ultimate value investor, and people followed him for years, and they go to Omaha every year, and yet, in the last 15 to 20 years, he's drastically underperformed his own benchmarks. And his style has changed, which I would say attributes in part to that. He's gone from capital efficient businesses to capital intensive businesses, buying railroads, buying oil companies. That is the antithesis of what he stands for and what his methods are, and yet he's doing it. So I'd love to get your take on this. Like, where do you think he's going wrong? Like, why is he doing this? It's completely against um, his methodology. And this is before that Abel joined as well. So this is all him.
Mhm.
So what are your thoughts on that? I'd love to get your take.
Absolutely. I think uh, you're partially right, but I think it has to be put into context because uh, part of the issue of the relative underperformance, which is just marginal, I don't think it's a huge underperformance, at least last time I did the numbers. But part of the reason of the underperformance is the problem of the size of kind of his portfolio and the amount of cash that he has to deploy. Because on the one hand, that limits the amount of opportunities he can realistically go after. Because something that's $1 billion to him, it's like that's not going to move a needle. And even if it will move a needle because it might 10x or whatever it is, uh, he can't buy it at the prevailing price in the market because he need to buy 50% of that business, and by doing so, he's going to bid up the price to a 2 billion valuation or something like that. So I think part of it is that he had that challenge, and so it was more difficult for him to be more nimble in that regard. But then the other thing I would say is, and this is actually something I talk a lot about in my book as one of like Wall Street's blind spots, or the things that kind of people tend to miss is that uh, inherently there's nothing wrong with a capital intensive business. It can be a bad thing, but not necessarily, because if the intensiveness intensiveness of the capital goes to things that have high returns on invested capital, then it doesn't matter that you need a lot of cash to produce more cash as long as you have that initial cash anyway, because you're getting high rates of return. So an example would be, say I have a trucking company, and each truck costs me $100,000, but the services that I can provide for with that truck, up to expenses and the driver and whatever it is, I can get $30,000 per year. Well, I'd be down investing in that business, even if I had to buy more trucks over time, because each truck is giving me a return on investment of 30%. So I think that the businesses that he's owned, the railroads and these oil companies, uh, in his mind and his vision, they have high returns on investment capital, and because he has a lot of cash and his companies have a lot of cash, growing through that capital intensiveness is not necessarily wrong. That is, of course, if they actually have the high returns on investment capital he suspects. And the last thing I'd add to that is that he was kind of boxed into that context also precisely because of the problem of his scale. It's difficult to have to deploy 10, 20, 30 billion dollars in the stock market. So if he has a railroad company, and that railroad company has the ability to reinvest because it can do more lines or whatever it is, then that kind of takes away that kind of problem for him. So I think it's a combination of those things, and that lead to the underperformance. I do think, and this is something we would never know, of course, but I do think that if we had gone back to 2000 and we say, Warren, donate 99% of your wealth and start again with whatever, a $50 million portfolio back then or whatever it was, uh, he would have done maybe a little bit different decisions, but because his hands wouldn't have been tied, I'm sure that even with a slightly different approach, he would have outperformed the market. At least that's my expectation.
Yeah, I mean, I agree with you in part. I will say that, I mean, buying a bunch of oil companies and railroads, there were plenty of companies that are that size, if not bigger, that were much better companies to buy. When you have those capital intensive businesses, there are plenty of large companies that are not capital intensive. Like, because that's always been his thing. And I agree. I mean, why buy a company? It's like buying a mining company. You take a bunch of cash, you shove it in the ground, and then you pull out a little bit more cash, and then it's worthless. Like, that's not a business. That's like a CD. And, and that's effectively what you do in mining, but it's not much different from oil. I mean, and you look at the oil companies, they've underperformed drastically for long periods of time. I just don't see it as a great business. And here's a guy who I understand the argument. He's best friends with the richest guy in the world, and his company is one of the best companies on the planet, and he didn't touch it. I understand maybe not wanting to look bad in the press, but your job's to make money, not how you look. So I'll give him a pass on the Microsoft one because I think that was a huge miss. But there's so many companies out there that are not capital intensive or are well run. Like a Walmart, for example. Walmart is an extraordinarily well run company. McDonald's, another extraordinarily well run company. Um, I didn't see him ever buy those, but he bought banking stocks, which are historically poorly run.
Mhm.
I mean, Wells Fargo had that problem, and and I get after the financial crisis, he walked around with a net and just says, "I'm just going to hand out a bunch of cash and I'm gonna put you all over the barrel." That was great for him, and that was an opportunity to do that. But there are other opportunities which he very much missed.
No,
COVID.
absolutely, and I don't want to imply that I agree with every decision he's made. Like for example, I've looked at Oxy a million times since he's bought it, just because I try to understand his mindset of why he buys it, and I get the points and the rationale. I mean, I do, but at the end of the day, I'm more in your camp where it's like it's not the best risk reward opportunity out there. I mean, why do you think this is so juicy? So again, I'm not saying that I agree with all his decisions or anything, but the truth still is that his investment universe came from being 40,000 companies or 30,000 companies that are publicly traded to maybe 2,000 companies. And so before he had less limitations. And maybe instead of buying the oil company, he would have found another more capital light business or another insurance company that was a more smaller cap, and that would have been a better decision. So I think those two things can be true at the same time. But yes, I do think he's missed some opportunities like Microsoft, and I think Google and some other big companies that maybe are not as hard to understand and could have been in his circle of competence that maybe he missed. But we all make mistakes, and he always says the biggest mistakes he's made, and I think it's going to be the same for me in my career, are the opportunities that you missed, right? The potential 10x you could have had, but you didn't for whatever reason, right? So
Yeah, I mean, I
that's kind of where I stand.
yeah, I mean, obviously, I'm trying to chop down the like best investor of our time. That's not my goal. But I think we all learn a lot from the mistakes of the successful people
Absolutely.
because they're the most successful and they're making mistakes, right? The thing I don't like about Buffett, my biggest rub against him is he used to have this goalpost of I got to beat the S&P over 10 years, and once he stopped beating it, he stopped reporting that he stopped beating it. So he just kind of shoved it under the rug and stopped talking about that. I think that was a little bit maybe, not the best, but yeah, it's good to see his mistakes because we all make them, and he's a smart guy, and he talks about how he wouldn't invest in tech because he didn't understand it. Okay, I give him a pass. He said that, and this is one thing I think a lot of people fail at is they feel like they need to be invested in everything. Like Apple's going up, we need to be an Apple. Why? There's 5,000 companies out there. Like, why does it
No,
have to be
no.
Apple? And so I like that kind of thinking because I think a lot of us get caught on the FOMO of, well, this is going up. I mean, during COVID, Apple went up a lot. Like, why? People didn't buy more iPhones. Like, they were buying more on Amazon, but Amazon didn't move. And so all these things that happen, they don't make logical sense, but you're like, well, hey, it's a missed opportunity. That's okay. As long as you didn't short Apple all the way up, I think you're fine. But I think not buying something is not an error. If it was an error because you made a mistake in your calculus and you should have seen this and didn't, okay, that's a learning experience. But I acknowledge to people all the time, like, I am not going to invest in everything. And if you want me to invest in the hot stock, I'm not going to do it. Go find someone else because that's not what we do, right? And I have to have that conversation. I'm sure much like you do. Like you have to
No.
talk people off the ledge. I'm sorry. I'm not going to get your dopamine hit for the day.
The,
Like
the
just
amount
because
of
it's going
times,
up doesn't mean I'm
yeah,
doing it.
the amount of times I've had to explain to people why I'm not in Nvidia has been, incredible. And it's not even me making the case of why Nvidia can't go up because, as you always imply in the conversation, it can and it has and it may continue to be, right? But it's a lot more about, the approach of trying to always find something undervalued, risk reward, circle of competence, and a different balance of things, and not just as you're saying, let yourself fall into the FOMO, right? And a lot of people, most people, in fact, from at least retail investor perspective, just buy it because there's so much hype and there's only positive headlines around it that they say, okay, then nothing can go wrong here, right? But it can't.
So I want to touch on one more thing as we kind of wrap it up because I just read this yesterday, and there's a report out. I think Michael Burry actually wrote it. I'm not 100% sure it was him, but I believe it was, where he says if you go back and look at the large cap stocks, large tech, the Mag 7 tech, what they're starting to do is they're starting to depreciate their NVIDIA servers over 6 years, 3 or 6 years, when in reality they're good for like 15 months, and then you have to get a new one. And he's talking about, and they're all footnoted, so there's nothing illegal. But
No.
when you see stuff like that, like how do you assess stuff like that? Because it's no one's reading the footnotes, even the analysts, and probably if he didn't say it, probably nobody even know about it because people don't read that stuff. But how do you kind of like deal with stuff like that? That's I call them shenanigans, but it's technically legal, but it really shouldn't be. Well, how do you deal with that in the value investing space? And I don't know if you have thoughts on that, if you've kind of read that news.
I didn't read the news, but I do generally question. uh, a lot of the kind of assumptions that are out there around AI, not its potential, but AI, its potential for return on invested capital, and much of which has to do with what you're saying. And so I do have an opinion. It's a soft opinion because I don't consider myself an expert in any way, shape, or form on this. But I do think that the biggest risk to this kind of AI transition that we're in is the possible and potential uh, overinvestment in the infrastructure that artificial intelligence requires, right? And part of it can be what you're saying, that right now things look pretty well for the hyperscalers, but it could be that they're underestimating the cost, as you know, Michael Burry said, and you're saying right now. And I do think you need to take it into account and try to be kind of realistic and think about kind of the history of hardware companies and how quickly things can go obsolete, right? Because if, like you're saying, if you know NVIDIA is coming out with a new GPU every 15 to 18 months, well, that puts a limit to, even if the GPU from the last version can last for 10 years, it's not going to be competitive for 10 years, right? So as an investor, you definitely have to question yourself whether the profitability that accounting practices are conveying actually reflects the profitability that you can expect. And my advice would be to be very conservative in doing that approach. And if 6 years for me seems a stretch, not in terms of useful life again, but in terms of obsoleteness. And so I would say, well, do the numbers, assuming maybe 3 or 4 years, and adjust depreciation upward to see what that kind of looks like, right? So, fully agree with that. I think it's a time to be very cautious. And so that's kind of the opinion I have on the matter.
Okay, awesome. Well, I appreciate your insight on that. Well, I appreciate you coming on the show, Jose. Give us some final thoughts and where can people find more about you?
No, absolutely. So I think the best place to find more about me is going to my book, where I kind of talk about some of these ideas we discussed today, but most importantly, kind of like the unique approach I think I bring to the table from how to value a business, and I try to kind of uh, in a understandable and digestible way explain what really drives valuation. And in particular, there's one kind of what I call blind spot, or one kind of knowledge gap that most people don't understand. And it's the most important thing, in my opinion. And that's why the book is titled Wall Street's Blind Spots, because kind of everything I try to teach around valuation revolves around this one central theme that we kind of touched over indirectly in our conversation. But if people want to know more about it, that would be kind of the best place to kind of get an idea of my mindset.
Awesome. Well, Jose, I really appreciate you coming on the show, sharing your wisdom with us. Look forward to have you back in the future, ideally in a time where value is more in vogue, which hopefully is soon. But yeah, I appreciate you sharing your wisdom.
Likewise, it was a pleasure to be here. Thanks for having me, Kirk.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right, that was a great interview with Jose. I really appreciate him coming to the show. Now we're into the panel portion of the show. We have our very own Barb Freeberg. Hey, Barb.
Hi, happy to be here.
Glad to have you here. We also have our very own Doug Hagren. Hey, Doug.
Happy to see you. Happy to see you, Kirk. Whenever, yeah. Anyway,
That's all right. Moving on, and we have a new panelist, Mark Walton, who was a recent guest. How you doing today, Mark?
I'm doing well, thank you. From a very wet and windy Portugal.
Oh, wow. I'm jealous. It's cold and snowy here. It's like 1 degree today. So, uh, awesome. You're not invited back, Mark. Unless you're bringing the hot weather. All right, so let's dive right in. So, Barb, what were some of your thoughts from the interview?
Finally, my topic, value investing. Yes, I have been waiting around for 2 decades to talk about value investing. I believe in theory it is the way to go. Who doesn't want to buy stocks, investments on sale? But clearly the markets don't agree with me. So, delving into what is value investing? How can we implement it today? Can we implement it today? Are the things that I would love to talk about with all of you great minds.
Yeah, no, I appreciate that, Barb. As you say, the value investing works in practice, but it doesn't work in theory. Um, anyway, I'm not sure anyone else got that. All right, Doug, what are some of your thoughts?
well, I think value investing isn't just misunderstood. I think we've talked about this before in ways. It's very misapplied through a very narrow Western lens. And I think from what I've gathered from his background, Jose's trying to bring a non-Wall Street, globally informed view about value investing. And I think there's as you said, it works, and it works in practicality, not theory, right? Wall Street has ultimately outsourced its soul to Excel, and individuals like Jose are trying to bring it back. It's not dead, but there's been a lot of looking in the mirror too long, and I think we've got to try to have an area where we're looking out the window, especially in an AI dominated market. The human judgment, especially one shaped across cultures, could be an opportunity for alpha. And the next wave of value is going to be a little bit different. It's not just going to be low PE. It's going to be low visibility. And from what I gather, from his position, he's betting on what the index builders haven't seen yet.
Yeah, no, appreciate that. And Mark, what are some of your thoughts from the interview?
I think that being a non-hedge fund guy, I mean, I'm from a trading background, so to me, a lot of it was. I think the danger is with people who are in this sphere that you end up with groupthink all the time. And I personally think in the last 5, 6 years, I've done very well in value investing by looking at cycles and trying to catch the right cycle at the right time. So gold has been amazing. Uranium has been really good. Rare earth is a good one at the moment. So I think when I look at people, you mentioned in the interview, you were talking about Buffett and he's not even met the benchmark. And I look at that and you think, well, understandably with him because of the scale of things, but if you're doing things on a smaller level, then for the man in the street, I found the interview a little bit over my head. And I think the average man in the street might struggle with it a bit because we didn't really get to the nitty gritty of, well, I bought this company for this reason and this is what it's done. And that would have made more sense to me. So that was my take on it, is that I think there's value everywhere, but you maybe have to think differently, a little bit more out of the box.
Yeah, I agree. I think it's a good time to be certainly doing that. So Barb, this is your bread and butter. This is your favorite topic and frankly mine too. And I've had to shove it under the rug for like 15 years since no one cares about value and value quote unquote doesn't work anymore. Just like international investing doesn't work. I'm using air quotes for you audio viewers. It doesn't work till it does. And obviously international has done very well in the last 2 years, in the last year and a half. So, um, you know, everyone's a little rusty when it comes to value investing because it hasn't really mattered for quite some time. And yet we're seeing a lot of signs that value investing actually is starting to matter. The sectors that are typically value oriented are starting to do well. This is beginning of February when we recorded this. Industrials, staples, energy, certain areas that people just left for dead. There's tons of value in those areas. How should people go about this if somebody has either never learned the value skill or is just really, really rusty?
There are a couple of ways to go. If you are a stock picker, if you are a fund investor, if you are a sector investor, or if you want to turn over the responsibility to someone else who is doing it. Now, if you are a stock picker, I would say that's probably the most challenging today because the key to value is finding a stock that is trading at less than its intrinsic value, its true value. And there's quite a few different ways to do that calculation. And I was doing that calculation in the 1980s through looking at different ratios, price earnings, price to sales, price to cash flow, return on equity, those type of things. The difference between today and the 1980s, other than I am so much older, is that I wasn't competing with algorithms back then. I was competing maybe with traders, but the atmosphere is totally different today. So if you want to get in and find stocks, you're competing with algorithms. Now, maybe you can go to the far reaches of the small caps or the far reaches of the global environment and find something, but it is a big job. So, what I would suggest if you are a value leaning investor, and this is what I do today in our own family portfolio, is I look for funds that say have a value bent because I am very aware that, first of all, I don't want to spend 300 hours a week looking at individual stocks, but I'll let someone else do it and put that in my portfolio. And fortunately, today, those value small cap funds are finally outperforming, as well as my international holdings, which I've been holding for decades. They're finally proving their worth. So that's what I would suggest from a practical viewpoint. If you have a value bend and if you are sick and tired, like some of us are, of seven stocks dominating the entire US market.
Yeah, I would agree with that. I think we're all happy that's going to stop. Um, so Doug, what are your thoughts on value? I mean, you've got a wide range of things you're interested in, but like, how do you think about value in a market like this?
I think the opportunity there is, and it's not easy, as everybody said here, is to figure out where Wall Street's blind spots are. I mean, that's your opportunity. Most of Wall Street has been really focused in hunting alpha, probably somewhere in the range of the same 20% of global equities. All right. And so there's opportunity out there when you talk about, when Barb talks about the seven, right, that we've been racing. I mean, the history, brief, and it's a brutally honest one, is that, it is Ben Graham, came up with this, concept, given really the godfather of 1934 security analysis. It was popularized by Warren Buffett. But the last 15 years, they've underperformed flashy growth and momentum plays. I mean, cheap didn't mean good. It just meant it got ignored. Tech has been dominating. Zero interest rates, you and I have talked about this, Kirk, very much led to a very healthy environment for the rise of tech and rise of growth and speculation because that money was so easy to come by. It was Fed-fueled liquidity, which distorted traditional value signals. And there was a brief resurgence in around early 2022, COVID, post 2021 era. But again, what happened? AI all of a sudden became the talk. Big tech became a rebound, and it put boring is beautiful back in the penalty box. Why I think it's going to quietly win, and you're seeing this, in what Barb just said, right? And you're going to see this in cycles. Value investors probably have to be the most patient investors out there other than bears, perma bears, right? Because perma bears, I mean, you got to be incredibly resilient to wait for that crash opportunity. Real and value investing is about buying more than you pay for. You're looking at cash flow, assets, brand power, human capital. It's not just low PE. It's high resilience and mispriced durability. And it's going to force you to really plug your ears, the whole cover your mouth, cover your ears, cover your eyes. Value investing requires patience. It requires contrarianism. I don't know if anybody gambles, but if you ever play craps, you can bet with the, hi, Kitty. I see that in front of the bar. I see a tail going. But it requires you to, generally most of the people around the craps table are going to bet with the roller. But there's the contrarian that's betting against the pass line, and they're not loved. They get a lot of hate because they're literally betting for failure. And in a way, value investors have to just block out all that noise and be very contrarian. And that's not easy. We're seeing this in all the social media world that we're in and the propaganda that's out there. It's very easy to be caught up in what everybody's saying. It's very difficult to actually sit there on the side and say, I'm going to stick to my values, I'm going to stick to my beliefs, and I'm going to go against, go straight into the headwinds, which means you're going to look wrong for years. And in a world that is increasingly dopamine driven through day trading and AI generated forecasts, independent thought is going to be the real edge. So if you're not willing to look like an idiot for a while, you're not investing, you're trend hopping. And so I think the opportunity today, again, we've seen it. Non-US equities, especially emerging markets, might start to come back again with the dollar. Sectors with bad narratives, utilities, all cap industrials, insurance, healthcare services, owner-operated family-run businesses that aren't chasing quarterly optics. Today's alpha is going to be hit in what feels uncomfortable, and that's where value investors eat.
Yeah, no, that's great. So, Mark, you're more of a trader. Like, how do you look at value? Because I mean, there's traditional value investors like Barb. There may be more fundamental based, but you identified, before there's some value in the markets, even from a trading
Mm.
perspective. How do you identify value as a trader?
Um, well, one of the things I would make a point, first off, with Bob and Doug have both mentioned, you've got to be so patient if you're going to be a value investor. And I find most people these days are not, as Doug's just mentioned. I mean, I used to trade Forex for clients, and they all want to get rich quick, and they all expect 100% a year and no drawdown. And I think that with social media, and especially with crypto, I mean, when crypto was going on, my entire family, we were in crypto. My kids were coming downstairs saying, it's gone up 20% again last night. So all these kids have grown up with this kind of environment. And then you've got the boring thing of, well, just put money in the S&P for the next 50 years and reinvest it all, and you'll have a pot when you're 75 or 80, which is so boring that really I don't want to do that at my age. And so I think there is a demand for quicker returns. And in answer to the question, for example, I would not normally buy the FANG stocks, but I bought the FANG stocks last April on the dip because I only buy something if it's got the potential technically to make at least 25% to a recent high in a relatively short space of time. So when you got things like Amazon came down nearly 50%, the sales are on, but it takes some cojones to do it because, again, as Doug's saying, I am buying when everybody else is panicking. But the statement as a trading perspective is we are paid to wait. And so I am watching different sectors all the time, and I know what I want to buy. But if it's too expensive at the minute, I just wait. And if there's nothing happening today, I will walk away and leave it. And in general, I say I'm not interested in the big stuff. The other thing is, from a European perspective, I need to make a bare minimum 10% in current markets to account for the dollar's devaluation last year. So more and more non-Americans are going to be looking overseas into emerging markets because of the dollar erosion. Now, as it was, I mean, gold went up 80% against the dollar last year. You could have just parked it in gold and you've made a lot of money. And I've been thinking for the last 5 years we're going to have a crash. So I have been heavily involved in gold and silver, and especially the miners, because the miners give you leverage. But when I've talked in the past to hedge fund people and wealth managers, oh, gold, there's no money in gold. No, no, and miners, this, that, and the other. But to me, the miners are still good value at the moment because nowadays it takes 10 years and $1 billion in the West to open a new mine with environmental studies and all the rest of it. And I have that confirmed by a client of mine who's a banker for Australian mines. And so the thing is, at the minute, I think last year there was more silver used than was above ground or was mined. So they're hitting reserves and there's not enough of it. The demand is going up because people are now going more solar, which requires silver. And I think it's Samsung, one of the big Japanese car companies, allegedly have got a new engine coming out that will do 1,000 kilometers on one charge that takes 30 minutes, which will suddenly make electric cars a lot more interesting. But there's half a bar of silver in every one by all accounts. So I've hedged with gold and silver, and as it is, the hedge has made far more than if I'd just been in stocks. But so to me, I look technically. I bought gold the other day. I bought silver on the dip because when silver came down from a technical perspective, it hit the 78.6 fib, it hit trend line, it hit at 55 EMA, which I also use. But I'd sat there waiting for it for weeks to come back because I had clients saying they'd missed the boat. And I'm saying, well, we don't want to buy at the top. We have to wait for it to come back. And it came back. Suddenly, the Wall Street Journal headline in the biggest drop in gold since 1980, but silver was up 60% in 1 month, this month, after being up 80% last year. And my best silver miner was up 300%. So for me, I have been involved in gold and silver on and off for 30 years. And sometimes it's a really poor investment. I mean, long term, a gold buff will always say, you just hold gold. I think the dollar's down 50% since the year 2000. And if you just had it in gold, it's up, I can't remember the figures, but it's a lot. But you have long periods of time. So for 2008, when the S&P came down 65% and took 5 years to get back to where it was, by which time, and you mentioned it in this interview, Kirk, when you were talking to Jose and you said, the pain involved at that time and the amount of people who will have bought the dip and it went down and down and down again, they would have been so battered and bruised that they would not have been in a rush to put money back into the stock market. But gold doubled and gold got back to where it was within a year. And then gold from 2012 just drifted and halved. And then 2016, a mini crash, 2018, a crash. And to me, the COVID thing was the ideal time to get into gold because inflation was going to become an issue with all the money printing. I did a webinar presentation in October 2020, and I said I thought that crypto could be the best investment of your lifetime. But one of the slides, because I was talking about hyperinflation and what could go on, and how regime change, and Iran's there at the moment. And the same month, in fact, the month before, Powell was saying, "Oh, we think that inflation will stay at 0% until 2023, and we're going to push it up." Well, they did a blooming good job because within 6 months it went nuts. So for me, that made sense to get into gold. But gold generally costs money to insure and store. So the miners, if a miner's got all the infrastructure, to me, there's still value in the miners.
Yeah, no, I like the perspective there. I kind of feel the same way. We've been hot on the metals for a while, and the mining is still undervalued. But that's actually why we got it last year. We got into miners because it was the only area that was undervalued. Everything was
Yeah.
super expensive, and we're just
Yeah.
like, well, let's just throw a dart and let's see if we can hit it because everything was just so crazy overpriced, and even now. But yeah, no, that's a good perspective. So Barb, when you're looking at finding value investing, what are the kind of things you look for? I mean, like I said, you got to dust off your value shoes to figure this out now because it's been a while for people. But like, how should people start this journey? Like, what should they be looking for? What should they be worried about? Is Buffett right all these years? Like, what's going on in your head?
If you are a value investor, then first of all, good luck to you because you do have to be extremely patient. If you want to invest in individual stocks, I thought what Jose said was fascinating that he looks through hundreds of stocks. And I totally understand that because I remember at the end of the 1990s, everything had incredibly high PE ratios, and trying to find a stock that was fairly valued. I mean, for me, it was like really impossible. I don't think I bought anything at the end of the 90s. So if you are a value investor, first of all, don't put all your money in a value because you want to be diversified, and don't put all your money in any sector because they'll surprise you and you'll find that you can't predict today the sectors that will outperform tomorrow. So that's advice number one. Be diversified. I mean, unless you are a trader who is on the markets 100% of the time, which I don't think most of our listeners are in that boat, then take a portion of your money and you can spend some time looking at individual stocks, but don't stick just with the US because although those of us in this country think we're everything, we're only 40% of the market. And so you really want to look across the entire market. There are many, many undervalued areas globally and sector-wise that you might want to start your search with. And what I have done in the past, and like I said, I don't do this anymore. I go with funds. Um, but those of others of you may still want to try your hand at stock picking. First of all, I look at the overall company. Do they have a product that is going to be in demand not only today, but in the future? Because don't look for a product that's dying. Yeah, it's going to be cheap, but it's not going to rebound. So find a product that has good growth expectations. But for whatever reason, and hopefully a short-term reason, the price has been pushed down. Maybe they had a bad quarter of earnings, or maybe they had a one-off problem that you think will be remedied over the future. Those are the companies to hone in on. And then check out their fundamentals and don't compare them with the S&P. Compare them within the sector that the stock lives. Because you can't compare a consumer staple stock fundamentals with a tech stock. They're different worlds. And so analyze those, see how, and you can use something like Morningstar or many, many different websites online where you analyze the things like cash flow, return on equity, PE value, any number of ratios, return on equity, to see how does it compare with its peers? How does it compare with its former self? Is it undervalued? But are there the growth factors that are going to propel this company in the future to outperform? And those are the companies that I would focus on.
Great. Doug, what about you?
Um, I think that, as the market calibrates to what seems to be higher for longer rates, I know with the new Fed chair, we'll see what happens, but it's still, we talked about this the other day. I think maybe the short-term trend might be lower rates, but I don't think that's the long-term trend. That's going to open up opportunity for rate sensitive names, companies with strong balance sheets, um, pricing power, low debt. Those things will likely re-rate upwards. Thing is, value investors probably already own those. So, if it's the case, you're probably sitting in it, and that's going to mean an opportunity for that finally to pop. That's where when you ask, is Buffett going to be right? Well, over the long-term trend, he has tended to be right. And I remember in the 90s, again, Buffett was stupid. He was losing. He wasn't in tech. Then everything crashed, and after the dot com, and all of a sudden, when the tide swam out or went out, we found out who was swimming naked. He wasn't one of them. Thank goodness. That's an image I don't want to see.
Me
But
neither.
the reality is that today's markets have been they're emotionally reactive, and that creates huge pricing dislocations. But that's classic value territory. And those who can stay unemotional and long term are going to harvest the alpha that's created by others' panic. And I think that's going to be more and more difficult because back in the day when trading was a little bit more arm's length, when you didn't have the information, market makers had more control, you didn't really have a choice to be relatively unemotional. But now it's in like everything else, it's in your face all the time. The next wave of value investing isn't just going to be low price, it's going to be low visibility and high survival probability. So if you can find underappreciated moats, things that might be distribution network, switching costs, embedded customer relationships, where things that are very sticky that could help businesses with low analyst coverage, and that's why it is another reason it's so difficult to be a value investor is there's very little, nobody's doing the work for you. You got to do your own work, and most people don't have that capacity. You're not going to find that many of these are going to have social media buzz. Management teams, going to have to, do your research. Do they allocate capital rationally, not just for headlines? The reality, unfortunately, investors today, for the most part, they want fireworks, and value investing is about keeping the power on. It doesn't make you rich fast, but it definitely can keep you from getting poor stupid. And in a noisy world, silence is a signal, and that's where you're going to find the value. But not everything in that silent world is going to be value. So therefore, you're going to have to really work hard to find it. Another area of just last on that, is owner operated family run businesses that aren't chasing quarterly optics. And we've seen this now even in bigger and bigger public companies. A lot of the decisions that have been made, what do the analysts want next quarter? So that's why you see a lot more volatility and a lot less investment in these larger companies to look beyond, the next quarter or quarters. Back decades ago, companies that didn't have so much information being extracted from them, so many eyes watching them, could make business decisions that were years in advance. They could make investments that might not have a return for a long time. That is not the case today. Everything's being watched, and if you're getting stock options and you've got stock investors and you've got all of this pressure on you about what can you do for me lately, they're not going to wait for your stock to miss and dip for quarters and quarters and quarters. They're going to sit there and expect it now. So you're going to make short-term decisions, and if you're a CEO thinking long-term, good to great type of mentality, and you want to invest billions in something that's going to take you to the future, unless it's got a buzz like AI and it's really, where they want you to do that. But now you're starting to see where those CIOs and those CEOs are looking at where's the return on it. It's already getting that pressure. They're not going to let you make those decisions because they're going to beat you up for it and you will be out of a job. So that's really, really difficult. Today's alpha is going to be hiding in what feels uncomfortable. This is why a lot of companies, public companies, have talked about going private again, so they can get rid of this and they can think longer term. But honestly, if you can live in that area, that's where you're going to find the value investment, where you can see that they're going to be under less pressure. But it isn't easy.
Yeah. Well, Mark, as a trader in this environment, I know we kind of talked a little bit about, where you're seeing value. I've been following a lot of traders recently, and they're looking at money flows. Money has been sitting in tech for a while, and now it has to flow out in somewhere else. And um, it can't all go into metals.
No,
Metals just aren't
no.
that big. So, what are the kind of equity areas outside of mining stocks that you would look at and say, all right, we're in a typical fashion, with kind of money flows, how do you see Where are the areas you think people should be looking for, for their
I
next ideas?
think that depending on the person's age and what they're trying to achieve and everything, is to have a percentage of your portfolio in the higher risk stuff. Because I remember in 2020, Paul Tudor Jones was quizzed about Bitcoin, and he said he started off saying he put 1% in, and then 6 months later he said I might put 2% in, and he said I actually think it'll probably make more money than all the rest of it, but worst case scenario, it's not going to hurt me. So when people used to come to me to trade FX for them, you would basically try to work the risk tolerance out. And if somebody comes and they've 1 million in total, it's like, well, you don't want to put more than 100K into Forex or crypto, etc. I think crypto will have its day. There was a meeting on Monday in the White House. At the moment, the banks are pushing back because with the stable coins paying out more interest than the banks claim that they're going to lose 500 billion over the next 5 years. In Europe, the banks are going to struggle if the British and the European push for a central bank digital currency. Not sure what that's going to do to regional banks. So I think crypto will have its day. We spoke about this before Christmas when I was saying, well, the stablecoin companies have to hold USD and they're putting the money into short-term treasuries. The Chinese and the Japanese are not buying it anymore. So there is an incentive within the Trump group to get crypto. So I think there's some money to be made still in crypto, and you can do it from in the stocks with Coinbase and some of the other mining stocks that you can do US based. I personally at the moment have got some money tied up in rare earth metals, and they've redesignated, they've even included silver into rare earth metals now. And if you look what happened with USAR, I think it's an ETF in October, before when Trump had threatened another set of tariffs on China, China turned around and said, okay, we're going to stop rare earth metals. They control 90% of the world's rare earth. And therefore, I understand what Trump's doing. And the other day, and I've read again today, they're going to increase the budget to try to help these companies because, again, it takes 10 years and $1 billion to open a mine normally. If somebody's going to open a mine for rare earth metals, they need to know the guaranteed price for it. So I think from a speculative point of view, there's money to be made there as well. But you don't put your shirt on it, but you have parts of it in that. I still think silver is a big play. The thing with silver, people who I've been involved with it on and off for 30 years, and people who are not involved say it's a bubble, it was bound to pop. But it's a supply and demand issue, and there ain't enough of it. And so the mines that are producing now, I don't generally bother with the Premier League, the top ones, the BHPs, etc., because they don't normally go up a lot. But it's more than the next division down, because not only are they making a lot more money if you're selling gold at 5,000 an ounce and you were selling it at 2,000 4 years ago, but they're also ripe to be bought out. So I have a selection of those. I have a selection of USA, and I also am still heavily involved in crypto. And ironically, today when we're recording this, Bitcoin's dropping again. And again, we'd spoke about this before Christmas. I suspect that the BlackRocks of this world are trying to push it down to hurt MicroStrategy, who may then start to dump it. So we may get a big flush again. But I think when you look at what's going on and how the BlackRocks of this world want to tokenize real world assets, and that's going to save them a lot of money, and that's going to make, there'll be no more T122 settlements. It'll be done instantly. I think that's the future, and I think that's the way it's going. And so to me, it's worth having some skin in the game.
Yeah, no, I think it's a great perspective, and it is very fascinating to watch the microstrategies thing.
Yes.
It seems like I was listening to somebody talk about this yesterday, and it's funny because on Wall Street, if you ever were running a fund and you disclosed your holdings to somebody else, they wouldn't just fire you, they would blackball you to the whole street because that's like the worst thing you could do. It's like
Yeah.
it's just terrible. And yet here's Michael Saylor telling everybody what he's doing, and
Yeah.
Wall Street's like, all right, we'll show you.
Yeah.
Like
Yeah.
that's
Yeah. Yeah.
that's how Wall Street works, and that's exactly what's going on.
Yeah.
If I had to guess, is they're targeting him because they know if he if he blinks or has to, or at a certain point it gets below and then then the board kind of votes him out and then they liquidate and
Yeah.
it flushes it and then they just buy. I mean, if you think about it this way, everything's really expensive and Wall Street and institutions got in too late. What would be the best thing for them would be to flush it all out, get rid of
Yeah,
everybody, and then they can go buy in cheap, and then it'll rise back to where it was.
yeah,
I have no doubt that's what's happening.
yeah. I
Never
think
know,
so too.
but I would not be at all surprised. So
But it
that's
could be
good.
it could be painful for a year or two. But I think
Yeah.
the same way.
But that's the
Um,
crypto cycle, right? It goes
yeah,
up 300%, goes down 70, 80%, up 300,
yeah.
like if you don't know how to ride the wave, then you get really burned. And I think a lot of people are new to it. So,
But people
um,
forget, sorry to interrupt, people forget as well, Amazon dropped 95%. I think it was in 2003. You
yep.
know, all these news sheets, tipping sheets. Well, if you just put 10 grand in Amazon at the launch when it was 50 bucks, you'd be a multimillionaire now. Well, how many people rode the 95% drop and then the 60% drop in 2008? And I think it's dropped 30 odd percent 4 or 5 times since. But they all forget about that. So Bitcoin has been insane. But the CAGR on Bitcoin, I think, still 150 a year. And like you say, all these big funds missed out when they were calling it rat poison and a Ponzi and a scam. Well, now they're in. Oh, well, now we've cleaned it up, lads. Give us your money. But yeah, I think they're going to flush it.
Yeah, agreed. All right. So we're going to wrap it up here. Final thoughts, Barb.
Well, we've had a couple of different perspectives. We've talked about I appreciated Mark's perspectives on being a trader, but all of us are not traders. And we all, though, do hold one thing in common, which is we want good, solid returns on our portfolios and the possibility for outsized returns at some point. So I want to echo what Mark said and what I have said all along. Whatever quote unquote speculative positions you want to have or contrarian positions you want to have, first of all, most of your portfolio, keep it diversified across stock and bonds, funds, individual, whatever, because that's where most of the market is. But if you have a hunch or you want to practice trading or you want to go for, say, a special corner of the market or corners of the market, go for it. But don't go for it with more than, say, a few percent, 5, 10% of your portfolio, because if you are wrong, then you can afford to lose it. So I'm Barbara Freeberg. You can find me on YouTube and also at Barbara Freeberg Personal Finance.
Great. Thanks for coming on, Barb. Doug, final thoughts from you.
Yeah, so value investing is, in my opinion, less about buying what's cheap and more about what's seeing what's real. It's about clarity over hype. It's about purpose over panic. And it's about understanding the deep connections between time, money, and decisions. And that same clarity is essential for affluent families when it comes to wealth. It's not just the markets, but it's across every area that your capital touches. Things like income, your retirement plan, your tax exposure, your real estate, risk posture, estate plan design, college funding strategy. The problem is that most people are going to treat these areas like a financial junk drawer. You got scattered accounts here, you've got disconnected professionals, you've got no unified map. When we look at things with clients, we don't just help families avoid paying for college, we help see the entire wealth picture. So we use advanced asset mapping tools. We bring visibility to everything you own, how it's working, how it's evolved, how each decision ripples across an entire long-term plan. Um, I focus on college, as people know who've listened. It's not just an expense, it's a wealth allocation event that affects liquidity, taxes, future cash flow, generational strategy. And it's in an environment where interest rates and borrowing costs continue to reshape income planning. The coordination is going to be survival. So don't just write checks for college and hope it works out. Don't just give your kids everything if it costs you the freedom to make smart financial decisions later. The main thing is to focus on the overlap between what matters most to your family and what you can actually control. That's where strategy lives. That's where we operate. If you want to learn a little bit more, go to our website, mergentadvisors.net. That's MERGENT. You could start with the free college, easy college report, or let's have a real conversation and really understand what matters to you and to make sure, that you're in a situation where you're not living through hope, you're living through a plan.
Awesome. Thanks, Doug. And Mark, final thoughts from you.
Um, I'm not a fan of just diversifying in the market, because I think if it comes down, the whole lot would come down. So I personally will always be thinking having some gold and silver. I've got I was buying more silver last year because I felt that there was a better potential return. Now I would start thinking more about gold. I want something outside the system, and even with college. When I look at it from the outside now, you've got so many kids in the UK that they're paying the college debt off and it doesn't even touch the interest. So obviously everybody's got to think about AI and the implications of it. But I wonder, I don't know, I'm not, you guys seem to have it within your DNA. When a child is born, we start saving for college. I'm kind of a mind nowadays, well, is that the right way for it? So I don't know. I'm not as conventional as the rest of you, but I certainly would not go along with just diversify across. If you just diversified across in 2008, the whole bloody lot came down. So for me, it's diversifying, outwardsly, maybe property, gold, etc., and a mixture of things. But yeah, people want to satisfy the need. Then the other thing is people to learn. Wall Street wraps everything up in such mystery that the guy in the street doesn't understand it. And I get people coming to me and saying, "Oh, I'll never understand this." And I just say, "Well, hang on. If the Americans are going to start focusing on rare earths and they've put this money in and they've explained the implications of what that's going to do, how is that going to impact something? That's where you need to look." I don't think it's rocket science. And I think sometimes it's deliberately, with the big boys, they deliberately, I can't remember the word, they make it as difficult as possible for the man in the street to understand. Is my perspective.
Great. Well, where can we find more about you, Mark?
Probably the easiest one is markwalton.com with a C. Mark with a C.
Awesome. Well, great to have you on as well. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.